Have you ever noticed how some people seem to build wealth effortlessly while others just never get off the ground? The truth is, most people don't fail at investing because they make bad trades. They fail before they ever even start. Not because they lack intelligence or opportunity, but because of how the human mind works when money, fear, and hope collide. Let's start with something uncomfortable. If you've ever told yourself you'll start investing when things calm down, you've already made one of the most common mistakes in the world: waiting, procrastinating, believing there will be a perfect moment to begin. There isn't. In fact, studies show that the single biggest reason people miss out on long-term wealth is simply not getting started. Think about it. Every year you wait, you're not just losing time, you're losing compound growth. A dollar left sitting in a savings account today is quietly losing value while inflation works against it. And by the time most people realize that, they're already years behind. The irony? Many of them blame bad markets or timing, when the real problem was emotional hesitation. It's not that people don't want to invest. It's that they're scared to. Fear is baked into our DNA. The part of our brain that once helped us survive saber-toothed tigers now screams danger at every time a market dips or a headline flashes recession. Behavioral finance researchers Daniel Kahneman and Amos Tversky won a Nobel Prize for showing how our minds consistently trick us when making money decisions. We think we're being logical, but we're not. We buy high out of greed, and we sell low out of fear. And here's the crazy part. It's not just beginners. Even experienced investors fall for it. M&T Bank's study on investor psychology showed that even people who've been in the market for years consistently earn less than the funds they invest in. Why? Because they move money in and out at the wrong times, buying when markets feel safe and selling when they feel scary. In other words, emotions wag the investor dog. Let's make this real. Picture March 2020. The pandemic panic hits, the S&P 500 drops over 30%, and millions of investors rush to sell. Who could blame them? It felt like the world was ending. But here's what happened. Within 17 months, the market nearly doubled. Those who held their ground, or even better, bought more saw one of the greatest recoveries in history. Those who ran lost twice, once when they sold, and again when they missed the rebound. That's the curse of loss aversion, a powerful bias that makes the pain of losing feel twice as strong as the joy of winning. It's why people cling to losing stocks, hoping they'll bounce back, or avoid investing altogether so they won't have to face potential disappointment. But avoiding pain is the same as avoiding progress. And fear has a twin brother, greed. The same emotional energy that pushes us to sell in panic also tempts us to chase what's already hot. In every bubble, crypto, dot-coms, housing, people didn't buy because assets were cheap. They bought because everyone else was getting rich. It's that herd instinct, the desire to belong. We're social animals, and the idea of missing out feels unbearable. That's FOMO, fear of missing out, wrapped in dollar signs. One of history's smartest minds fell for it too, Sir Isaac Newton. After making a tidy profit in the 1720 South Sea bubble, he couldn't resist jumping back in when he saw others getting richer. He lost nearly everything. His famous quote sums it up: "I can calculate the motions of the heavenly bodies, but not the madness of people." And that madness hasn't gone anywhere. The modern investor still fights the same battle every time they open their trading app. Prices drop, fear kicks in. Prices rise, greed takes over. Either way, emotion wins and logic loses. So why do 90% of investors fail before they begin? Because they start with the wrong expectations. They think investing is about beating the market instead of understanding themselves. They think the game is about picking the next Tesla or timing the next crash, when in reality, the game is about staying calm long enough for your decisions to compound. Richard Russell, author of the Dow Theory Letters, once said, "The difference between rich and poor investors isn't intelligence, it's pressure." The wealthy investor doesn't need the market to make money today. They're patient. They wait for value. Meanwhile, the average investor feels desperate to make money fast. They chase trends, overtrade, and burn out. The AIER report calls this the little guy syndrome. The small investor doesn't understand compounding. He dreams of big wins, forces trades, and treats the market like a casino. And because of that, he keeps running up the down escalator. But if he simply invested regularly, spent less than he earned, and reinvested over time, He'd quietly become wealthy, just like the patient investor he envies. The difference again is mindset. Discipline over excitement. And that's where the next big mistake comes in, not having a plan. According to Investopedia's data, most beginners jump in without setting clear goals. They invest reactively, buying a hot stock here, chasing a tip there, without any roadmap. When markets swing, they panic, because they never defined their timeline or risk tolerance in the first place. Without a plan, emotion becomes the strategy. And emotion is a terrible investor. A financial plan doesn't have to be complicated. It can be as simple as, what am I investing for? How long can I keep this money untouched? How much can I handle losing without losing sleep? Once those questions are answered, everything gets easier. You stop reacting to every headline because you know why you're invested in the first place. Another huge mistake beginners make: not diversifying. They pour money into a handful of safe stocks or hype companies like Apple and Tesla, thinking they're protected. But when those few names drop, their entire portfolio sinks with them. The fix is simple: use index funds or ETFs. They automatically spread your money across hundreds of companies, giving you exposure to growth while reducing risk. And here's a killer insight from behavioral finance. Overconfidence is one of the most damaging traits an investor can have. Most people believe they're above average at decision making. But statistically, that's impossible. The more confident someone feels about their ability to time the market, the worse they usually perform. This is why so many investors underperform the very funds they invest in. They jump in and out based on short-term gut feelings, driven by recency bias, the belief that whatever happened last will keep happening. Markets go up, they pour money in. Markets fall, they pull money out. It's human nature, but it's financial suicide. So how do you protect yourself from your own psychology? The same way pilots do, by relying on systems instead of instincts. Automate your investments. Set a schedule and stick to it, no matter how the market feels. If you invest every month, through good times and bad, you remove emotion from the equation. That's what long-term winners do. And when markets crash, and they always will, remind yourself of one thing: it's supposed to feel scary. That's how opportunity hides. The greatest buying moments always look like disasters. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. But of course, saying it is easy. Doing it is another story. Your brain fights back. It whispers, what if this time is different? It anchors to the last price, convinces you the worst is yet to come, and pushes you toward the herd. And yet, the herd is almost always wrong. The M&T study put it perfectly. Emotions often wag the investor dog. Investors sell when the market bottoms and buy when it peaks. The emotional roller coaster never stops unless you step off it by following a plan instead of a feeling. Another silent killer? Ignoring taxes and fees. You'd be amazed how many new investors think only about returns. But a fund with a 1% higher expense ratio can eat up tens of thousands of dollars over decades. The same goes for constant trading. Every move triggers taxes and fees that compound against you. The less you touch your portfolio, the more it grows. So now, let's zoom out. If fear, greed, overconfidence, and impatience destroy investors, what builds them? The answer? Systems, self-awareness, and time. Systems keep you from reacting. Self-awareness helps you recognize when emotion is driving you. And time. Time does the heavy lifting that no human ever could. It's the only true edge any investor has. Every story of financial failure starts with one common mistake: trying to outsmart the market instead of outlasting it. The goal isn't to buy cheap and sell high, it's to stay consistent long enough for compounding to do its magic. And that's why 90% fail before they even begin. They never give their strategy enough time to work. They chase results instead of building habits. If you can resist that urge, if you can start small, stay diversified, automate your investing, and keep your emotions out of the driver's seat, you're already ahead of 90% of people out there. Because the truth is, investing isn't a game of intelligence, it's a game of patience. The market doesn't reward the smartest, it rewards the calmest. So next time you see a crash, don't panic, don't chase, don't freeze. Just remember, your emotions are the biggest risk in your portfolio. Control them, and the rest will take care of itself. Watch the next video and see how the people who understand where the money's moving next always win. And if you're serious about staying ahead of that shift, hit subscribe. You'll want to see what's coming next. Oh, and if you're thinking of starting your own investing journey, take a look at the link in the description. It's the platform I personally use to explore global markets.